Welcome back, folks. This is video 2. It's all about asset selection. Now, in the first video, Hayley and I talked about why investors invest in the first place, why Hayley did, why I was investing in property, and how you can better understand what your clients are going through if you understand that. So if you haven't seen that video, I suggest you click on the link below. Go and watch that one first, and then come back and watch this one. So in this video, we're going to talk about asset selection. And I guess the basic premise for this is not all properties make for great property investing. And I guess the fact that we use property as a basic need, as a form of shelter, can sometimes confuse the matter, Hayley, because it's easy to think all you got to do is put your name on a title, but ultimately there are good properties and there are bad ones.
Correct, and I've seen good ones and bad ones over the years. I guess it depends on what you're actually looking for and what the client wants to get out of it as well, because there's a whole lot, and I know you're going to go into a lot of detail on this, but there's a whole lot to understand when it comes to, you know, whether you want a property that is bringing in a high yield or whether you want the high growth and hold it for a long period of time. So it just really does depend on what the client wants out of the equation. It's so important to actually ask them, what are you after out of this property?
Yeah, good point, really good point. So I guess if we talk about the basic categories of property investing, you're either a residential property investor or you're a commercial property investor. And for all intents and purposes for this video series, we're going to be focusing on residential, other than to say that they really are two very different investment vehicles, because most people are familiar with residential, given the fact that they've got to have a roof over their head, but commercial comes with some pretty good upside. Usually the tenant pays for most of the outgoings. In a lot of cases, they provide positive cash flow, but it takes you up a certain part of the risk scale that not everyone is comfortable with. So I guess for the purposes of these videos, we're going to talk about residential.
Resi, yeah.
Now, we often have a question around what's the difference between growth and yield, and why are these terms important? And we're really going to cover those with you here, because if you're an investor, you sometimes your goals are different. Sometimes you might be chasing an outcome where the value of the assets grow enormously, and you're okay with cash flow.
Yep.
In other situations, people might not have enough cash flow to be able to hold it, and they really rely on the yield. So we want to talk through three categories: the growth asset,
Yep.
the balanced asset, and the yield asset. Can you talk us through the growth asset?
Yeah, so growth asset will be when you're buying a property and you want to hold it for a long period of time. So you get that capital growth when you go to sell it. So the example we did in the first video, you know, you spend $250,000 on an apartment, you sell it 10 years later, it's worth $500,000. So that's pretty good growth. You want to get double that income. So that would be a goal, and a lot of owners will go for that, but then they've often got to top up the property or pay for a lot of the outgoings to actually hold it to get that growth at the end of the day. And that's something that a lot of people can't do, particularly in the financial climate that we're in at the moment.
I think that topping up is important, right? Because if someone, ultimately, all things being equal, my personal preference as a property investor is you chase growth, because growth actually is, over a longer period of time, it will drag the rent up and the yield will be usually in excess of some of the yielding properties that you're chasing. But for all intents and purposes, if we're chasing growth, what we're saying is we want the value of the asset to grow in value. We want that to be the priority. But it often comes at a cost, because if you're getting high growth, it usually means lower income or lower yield, lower income. And therefore, to Hayley's point, if you're lower income, quite often you're tipping money in to hold that asset. But the whole reason is because over a longer period of time, it's going to grow in value.
Exactly. Yep.
So that's the growth asset. On the other end of the spectrum is the yield asset. So can you talk about the growth yield trade-off on a yielding asset?
Yeah. So I'll give you an example. When was it? 10, 15, 12, don't know, years ago I bought two little apartments, Fitzroy, and they're tiny. So banks don't like lending on tiny. It was a bit of a challenge, but I got it done. But one of my owners actually wanted to sell and rang me and he said, I want 195 for the little one, 235 for the big one. Studio apartments in Fitzroy, only 6 on the block. So my ultimate goal was I'll just buy the whole block over a period of time. Now I can't because the prices went up. But the yield on those properties is off the scale. So, paying $195 for one, spending $5,000 furnishing, they're now on Airbnb. But I'm getting anywhere between $3,000 and $5,000 a month per property. So high yield, but the growth hasn't been massive. So if you look at the asset, I paid $400,000 for them roughly. They're probably only worth $600, $650 now, and that's way over 10 years that I've held them. But they've been paying for themselves.
Yeah.
Right. So with that particular property, my goal was to buy them, hold them, and have that yield kick in to pay for themselves. So yeah, they've been good little performers.
Yeah. So if you pick up on a couple of those points that Hayley made, the growth had been lower, but the income had been higher. So quite often there's an inversely proportional relationship. If I want more growth, and this is in Australia, if I want more growth, I have to accept lower income. If I want more income, it usually comes at the expense of growth. So you've got the two ends of the spectrum. You've got a growth asset, the other end you've got a yield asset, but there is one in the middle. We call that the balanced asset, where you compromise a little bit on growth, but still getting it. But it means that the income has come up to the point where what you're getting out of the market. So you might get a 7% return in growth and maybe a 3% yield of a combined of 10%. Or the other way, with a yield asset, you might get maybe 3% growth with 7% yield, so a combined 10%. But the one in the middle is maybe 5% growth and 5% yield.
Yep.
So you're getting a little bit of both. It might mean you move a bit further out from the main population centres or a bit further out from the main CBDs.
Yeah.
But your portfolio might dictate that I chase growth at the beginning, I go balance in the middle, and I maybe chase yield at the end to retire at the income. But I guess as a property manager, it's important for you to understand the differences between the buckets that you would broadly put these properties into.
Absolutely. And often property managers, if you're working within an agency that has a sales team, the BDM or senior property manager will put a price on that property so that the sales team can go in and say that it's going to get $350 a week, $500 a week, whatever it might be. You don't want your sales team to dictate the price that they think the rental will be, because I'll always put it higher. So that's really important for property investors to then be able to do their sums and take those numbers to their accountant or financial advisor to say, this is the sort of property that's going to perform and this is what it's going to get, so that they know exactly what end of that spectrum they're on and what they can afford to do.
So I guess we go, okay, so resi versus commercial. Okay, we have a preference in this discussion around resi. And then we go, okay, what broad bucket do we put the asset, the property in? Is it growth, is it balance, or it's yield? The next thing is, okay, your clients that you're dealing with ideally want to be buying an investment property that we would consider is investment grade. So what does that actually mean? And the first thing I want to talk about with that is, despite it being for investors, it makes sense for them to buy something that's owner-occupier appeal, because owner-occupiers have 70% of the market, roughly 70% owner-occupiers, 30% renters. So it kind of makes sense. Particularly if you're chasing growth, why wouldn't you go and find a property that the owner-occupiers like? Because they will drive the market, and you as an investor get sucked along for the ride. So that's really, really important for owner-occupier appeal. But Hayley, a lot of people, when you say that, you go, I don't want something with investor appeal because I'm an investor. It's like, yes, you're an investor, but don't chase something that's in the minority. Chase something that's in the majority. And an example of investor appeal is student accommodation, or properties under 50 square metres, or service departments. If you put a for sale sign out the front, the owner occupier isn't as interested.
Correct.
But what are your thoughts on that sort of paradox. Okay, I'm an investor, but I should be chasing owner occupier.
Yeah, I mean, it really does depend on where the client is and what their ultimate goal is. So I bought a property years ago in Geelong. I have sold it, but that, I think I held it 7 years and it more than doubled, you know. So you've got those sort of properties as well, where that was an investor. That was, you know, Geelong West. It was a really good property, lot of land, really good street. You know, those sort of properties would appeal to an investor or owner occupiers. So you have those sort of properties on the market that can be really, really good for a portfolio.
So there's a living example of what owner-occupier appeal does for the portfolio. So owner-occupier appeal. The second thing is scarcity, and the quick way to sort of summarise why that's important is imagine you've got something that's unique that 3 or 4 people are interested in, and you put a for sale sign out the front, and you get those 3 or 4 people fighting for it.
Yep.
That's obviously positive for it to increase in value. But the alternative is you've got 100 properties that are the same,
Yep.
and it doesn't have the same scarcity value.
Exactly, yeah, supply and demand. It happens with rentals as well. Like we put a property on the rental market and some of them are just fly out the door, and you've got multiple applicants for it, and other properties will sit there for ages because there's 50 that get released all at the same time.
Yeah.
Scarcity.
Absolutely. The more scarcity that you can have, the better. Even
Yep.
if you're getting a medium density, so let's just say an apartment, for example. If you were going to buy one of those old 1970s style blocks that have no pool, no caretaker, no lift, but they're in beautiful streets,
Yep.
or you might go and buy a 30s style Art Deco building that has some character, and versus the big sort of high rise that has hundreds and hundreds and hundreds of them.
Yep.
You can see the real contrast between those two alone.
Absolutely.
1 of 6 versus 1 of 200. That scarcity will pay you back in spades as an investor.
Absolutely.
So you've got the owner-occupier appeal,
Yep.
you've got the scarcity, and the third thing is it's got to be investment grade. And I see investment grade in 2 ways. One is a price point, so not too low that you're getting problems with tenants and vacancy rate, and not too high that you just can't afford it. So, I think we'd all agree that if we went to Toorak or Vaucluse or Bulimba, all across the country, go to these beautiful suburbs. Historically, they've done really, really well in growth, but for most investors, they'd run out of money.
Yes.
Their cash flow would be challenged by that. So, investment grade price point, but also, Hayley, I'd like you to maybe talk to also having a track record of being able to see what the property's done versus sort of brand new.
Yeah, absolutely. So I like to be able to Google an address, comes up with all the, when it rented, what price it went for, when it sold, what price it went for, because you want to see a history of that property's performance. So if you've got a property that 200,000 here and then it sold 7 years later for 220, that's not a great performance. You want to actually see that the prices are going up year on year, or definitely after 10 years at least. So yeah, I think property performance and history is really important. Super
important. So to picking up on your point, if I can actually go and see all those transactions that have happened in the past, I can actually see if this because unlike, when you do shares and it always says in the prospectus, history is no past history is no guarantee of future performance.
Yeah.
With real estate, I actually think past history is a reasonable expectation of future performance. Not much changes. The location, there's not a lot. Even in suburbs where they've had really stigma events, maybe mass murders, it only takes about 10 to 12 years for that to flush out, and then all of a sudden the location doesn't change. The proximity to all the main drivers still exists. So that history is important versus buying something brand new, and there is no history whatsoever.
Correct.
And so you're taking all the risk.
Yep, you are. And I've seen really good transactions with brand new, but I've seen some real disasters as well. We had a client years ago that bought off a plan, and when it came to the final valuation prior to settlement, all the properties came in 100K under. So they had to come up with 100,000 to make them settle. And then the prices that the agents put the properties on at was about $200 a week under what they'd told they could go for. So instead of getting $550 a week, they're getting $350 a week, and it was just really tough. And we picked up a few in that block, and it was, I felt really sorry for the clients.
Well, it comes back to that scarcity point, doesn't it?
It does.
If you don't have any of that, you lose your position of strength versus being in a position of power. So,
right.
All right, so we've covered off residential versus commercial. We've also gone, there's 3 buckets that we can do: growth, balance and yield. We've just talked about investment grade, which is owner-occupier appeal, scarcity and investment grade, price point, as well as some history. The last thing we really want to talk about here is what drives property prices. And there's 3 things that we want to talk about here. One is economic activity. The second one is human interest. And the third one is human behaviour. And I think for a lot of people, understanding these fundamentals makes a big difference. So economic activity is really how close are you to where the jobs are. Mm-hmm. And that could mean, like, if you think about 2 extreme examples, imagine if we're buying in a suburb of Melbourne. Mm-hmm. How close are we to the Melbourne CBD is the obvious one. Versus what if we were to buy in the northwest of Western Australia, where all of the jobs are coming from a mine? You've still got proximity to economic activity. So are those 2 things considered equal? Yeah,
it's an interesting one, isn't it? I guess, I mean, again, I haven't done a lot interstate, but I know a lot of people can make some really quick money when it's in the mining area. But then if a mine closes, what happens?
What happens?
Yep.
So it's about the sustainability of that economic activity,
absolutely.
Isn't it? So we've got to have more than just proximity to economic activity, because Melbourne, a Melbourne purchase has proximity to the Melbourne CBD. Far northwestern Australia has access to the mines. Okay, so what's next? Well, the next thing is human interest. And that's where you go, well, when I'm not working, what do I like to do? And again, if those 2 examples, you got, if I'm in Melbourne, we both live in Victoria, we can go arts or sport, or there's lots of diversity based on what you like. You might like cafes in Richmond, I might like cafes in Yarraville. It could be a whole range of things, but the human interest component is that when I'm not at work, there's lots to do.
Yep.
Whereas in the mining town example, not so much.
Not so much. If
the mine wasn't there, chances are people would be leaving in droves.
That's right. Yeah.
So that's another layer that we can put here, so that you can understand. You might be managing a property for a client that is close to a big economic centre, but you also might be managing a property for a client that's 4 hours commute away. So proximity to that economic activity starts to wane, and that's why you understand the performance of those properties. So we've got economic activity, we've got human interest, which is what I like to do when I'm not working, and then the third one is human behaviour, which is a status test. So you might want to talk to a couple of examples of that in Geelong, where one suburb, and you tell someone that I live in that suburb, everyone sort of goes, that's great. Yeah. Versus another suburb where people go, that might have some stigma attached to it.
Yeah, and Geelong is like that. So, Geelong West, you got Newtown, you got some really beautiful areas around there. And then, you might say, I live in Whittington, or I live in, Corio or Norlane, and people go, oh, okay. So, yeah, there is that. There's definitely a stigma with different areas. But we also do see some areas that really change over time, and they have more cafes and more restaurants, and people really want to go there. So there's those sort of the areas that sometimes you can get into a market at a really good time before those areas change, and you see a definite uplift in your income or your asset value.
I think it's a really good point. It's this, the human behaviour stuff is not fixed. Like if you even think about here in Victoria, there was once a time when if you said to someone to go and invest in Footscray,
yes,
they would have said absolutely not.
And Yarraville. I remember Yarraville. Years ago, someone said buy in Yarraville. I'm like, yeah, right, whatever. Yeah. Look at it now.
Now it is gentrified enormously, and if you could get someone to buy in that suburb at the right price, they would jump all over it. So
absolutely.
So hopefully that's helped you folks. We've covered a fair bit there. One is, resi versus commercial. The next thing is the three buckets around growth, balance and yield. Then we talked about investment grade, which is owner-occupier appeal, scarcity and investment grade. And then we brought it home with what kind of broadly drives price when it comes to assets, and it's that access to economic activity, human interest and human behaviour. So what are the takeaways we want to share with everyone watching today, Hayley? What would you say, based on having that knowledge, what are some of the conversations that property managers could be having with their clients?
Talk to your clients and actually find out what they want out of the investment journey. So if they've just bought a property, and the example I gave before about a high rise where it came in a lot lower, they said, we just need to get the most out of this property because we were expecting it to perform differently than what it is. So I knew that I didn't have a lot of money to play with, that I had to try and get the maximum price with very little fuss, so that they could continue to hold those properties until they actually started performing a lot better. But their goal was to keep them for a 10-year period. So over that 10 years, what can we do to try and get them the most value out of that property so that they can continue to hold it for that period of time? So really understanding where your client's at and what they need from the investment property, I think is really important.
Yeah, and I think your experience is paramount there. I mean, it comes down to human 101 dynamics, isn't it? I mean, if you build a relationship with your client, not based on is the paperwork in, there's a hot water system that needs mending, it's like, what is it that you're actually doing this for? What's your big picture goal? And then they might confide in you, because quite often property investors don't have a lot of people that they can talk to.
No.
Because we do live in a tall poppy syndrome country, that they might not have these conversations really regularly. So if you're saying, what's your North Star? Why are you doing this? What type of asset you're buying? Have you thought about its owner-occupier appeal? And then they might come to you and say, look, I'm struggling with the interest rates at the moment. I'm not sure how to hold the assets. You can, in our next video, we're going to talk about some lending and some tax that you can talk to them about. But ultimately, you can have these quality conversations where you're building the relationship, and all of a sudden you position yourself as a trusted advisor.
Absolutely. Yeah.
So hopefully that's helped you folks get a better understanding. In the first video, we talked about why we do it in the first place. In this video, it's not just about buying any property, it's about buying the right property. Now, in the next video, we're going to cover off some concepts around tax and lending. And to be honest, it could arguably be the most important video that Hayley and I do, because if you do grasp these concepts, boy oh boy, are you going to be not only positioning yourself as the expert in these landlords' world, but I'm pretty sure you're going to have a better time doing your job, largely because you can add value and look for opportunities to help your client rather than, in some cases, being the place where investors go to, cash flow issues, all that sort of stuff. So
absolutely.
Stick around for that video. Thanks for your input on this one, Hayley. And if you've enjoyed this, feel free to share it with anyone that you might think adds value to it. But otherwise, we will see you in the next video on tax and lending.